typically what happens is when a sellers are selling their home, they have a ton of equity built up. Usually they're either going to use that equity as a down payment, or they want to use that equity in addition to the cash that they're going to put down as a down payment.
You know, it's important to take into consideration that this isn't a long-term solution. This is a very short-term, just to bridge a gap between a sale and a purchase. Qualification. So you might be wondering, hey, how do I qualify for this loan? That's a great question.
Any developmental project, there's always things that you can run into that are unforeseen costs, such as right now we're seeing some of the COVID issues. That's going to extend out your costs, and you're going to be paying on money even though people aren't actually working. So that could be an issue that you run into.
What happens if you want to buy a property, but you don't have the money and you're waiting to sell another property? Well, unfortunately, a lot of new investors will just let that deal fall apart, but there's actually solutions out there for us investors. In today's video, I sit down with Josh and Ehren from Findlay Mortgages, and they break down exactly what the deal is when it comes to bridge financing. I'm really excited for this video because bridge financing is something that, again, I think only sophisticated investors stumble upon through experience rather than really learning about when they first get started. So I really appreciate Josh and Ehren taking the time to break down on my YouTube channel exactly what the deal is and how bridge financing works, and let's dive into that video right now.
All right guys, Aaron Laycock here.
Josh Findlay Mortgage team.
And today we're going to be talking to you about residential commercial bridge loans. So to start out, we're going to take a look at what a residential bridge loan looks like. It's a short-term loan, usually offered by the big six banks, and the maximum amount of loan that you're going to be able to take out is usually around $200,000 for a majority of 120 days. Now, why would you need one of these bridge loans on the residential side? The most popular case is that you're selling your home outside of your purchase date. So typically what happens is when a sellers are selling their home, they have a ton of equity built up. Usually they're either going to use that equity as a down payment, or they want to use that equity in addition to the cash that they're going to put down as a down payment. And that's going to help to reduce your loan to value and also help to reduce the costs associated with your monthly payment. So we're just going to walk you through a quick example of what a purchase and sell is going to look like in terms of a bridge loan. So the closing date on the home that you're going to purchase, let's say it's 35 days out, but you're selling your home and the closing date is 90 days out. So there's about a 55-day gap between your closing of your new purchase and the selling of your old residence. Now for this example, we're going to use a purchase price of $500,000. And as it's going to be your primary residence, you're able to get away with that 5% down. But like I said, you've already got some equity built up and you want to reduce the loan to value and some of that cost. So that 5% deposit that's coming out of your cash, we're going to use $25,000. And let's just say that you have about $300,000 of equity and you want to use, $125,000 from that sale to add on. So what does that look like? Your total down payment is going to be $150,000, and we're going to minus that from the deposit that you've already put down. So that's that $25,000 out of your pocket. That's going to leave us with a $125,000 bridge loan. You're going to get that loan from the bank, and they're going to give you that to help extend the time from your purchase to the sale of your property, which then you can use the equity to pay out that loan.
Qualification. So you might be wondering, hey, how do I qualify for this loan? That's a great question. So you don't specifically qualify for the bridge loan, you qualify for the purchase of your home. So I mean, if you're going to qualify for the purchase of your home, then the bank is basically lending or giving you this opportunity as a service for a little bit of a fee to be able to move forward with your purchase. Now fees. Now, it's often similar fees to opening like a line of credit. It's not crazy expensive, but there are some fees incurred when trying to do this and trying to transition from an early purchase to a late sale. So what's going to usually happen is it's going to be a nominal flat fee, a few $100, maybe $200 to $500 depending on the lender, and they're going to have like a percentage rate, usually around prime +2 or prime +3. It's important to take into consideration that this isn't a long-term solution. This is a very short-term, just to bridge a gap between a sale and a purchase.
Okay, so the second type of situation where we're going to see a bridge loan, and there's a ton of different ways that you're going to see it on the commercial side. And we'll go over those in a second here, but let's just take a look at what the general terms you're going to see on that bridge from the commercial side. So the transaction size it really isn't limited to a cap in the actual valuation. It's going to be limited to your actual loan to value on whatever property you're getting that bridge loan for.
Yeah, so for a term, I mean, bridge basically means like filling a gap, a short-term gap. So these specific type of financiers aren't looking for an extended loan term. They're looking for a very short term, but it's usually predefined. So, it can be upwards of a week for really private money to primarily we see about 1 year terms or 2 year terms develop depending on the development project.
Yeah, it's usually based on the as-is value as well. So keep that in mind when you're getting an appraisal done. It's not going to be the as-complete value. But the key point here is that it gets your project further along to the valuation that you want to start getting more permanent and more long-term financing off of, per se, such as construction financing. And that's one of the things we're going to talk about. So the loan to value of the actual bridge loan itself, not the acquisition value, is somewhere between 65 to 85%. And there's going to be a ton of different factors that come in to determine this, such as what the project is, the size, the loan value, and where it's located as well too. And the interest rates, like I said, it's going to vary differently, but on the lower and less complex projects, you're going to see interest coming in starting at 6.5%. And the big thing that we want to focus on with the bridge loan is what is your exit strategy, and the majority of time it is either a refinance or a selling off of the property.
Why would somebody use this? That's a great question. So when people take a look at bridge financing, especially short-term bridge financing in the development space, it can be very expensive because it's the first tier of lending or the first or second tier of lending in the stage of development process. So this is going to be an expensive stage of lending, but somebody would use this specifically maybe for site servicing costs, to change zoning on property, to be able to renovate maybe a dilapidated a rental property and bring it up to where it has to be for the after renovation value. There are many different reasons why somebody would take on this short-term bridge financing, but again, as Aaron said, finding that exit strategy, whether that's changing the zoning or finishing the renovation, getting that refinance, that's the most important part of bridge financing.
The other time you're going to see these bridge loans used is development financing. So this could be anywhere from, building a 10 to 12 unit duplex all the way to a large multi-tower condominium. In any developmental project, there's always things that you can run into that are unforeseen costs. That could be such as right now we're seeing some of the COVID issues where construction gets put on hold. That's going to extend out your costs, and you're going to be paying on money even though people aren't actually working. So that could be an issue that you run into. Lot servicing, paving of that lot, parking lots, such things like that. Demolition, if you're purchasing land that already has previously existing structures on there, you're obviously not going to want those on there during the construction, so you're going to have to incur some demolition costs on there. If you are developing something such as a condo, there's going to be units that are going to have to be sold preemptively. You're going to need a sales center to be able to go through and process those sales. And then some other things as well too is just first type of construction to get that project moving along and get things moving to be able to be more appeasing to larger construction financing or better financing options for a more longer term.
Yeah, I think it's also important to realize that the loan to value on these types of loans are specific to the project or the type of property you're looking to get the loan against. So for example, if you're looking for a piece of raw land, the majority of these private lenders out there or these short-term bridge financing companies are looking at around 50% loan to value of that piece of property to extend you for that year. As obviously you move down the development stage, the loan to value changes, and depending on if it's a cash flowing property or if it's a pre-existing property, it's going to be a handful of different factors that are going to go into how much money that a lender is going to be able to extend to you for that project.
Yeah, and another important thing to remember too is, we do deal with creative financing solutions, and sometimes when these bridge loans do come from a private lender, we can actually build some of those interest costs into the loan itself, and that helps with feasibility as well too. So keep that in mind as well. Like I said, creative solutions for everybody.
Again, so when you're sitting down with your mortgage broker, sit down and talk about the strategy that you're looking to implement, talk about the exit strategy, and then the broker is very easily able to find a solution to move you towards that strategy. So have a clearly defined strategy, have a plan, have steps that you're going to take with your mortgage broker, with your power group, to be able to move forward with that project.
All right, guys, so that's basically it for the bridge loans. They come in various shapes and sizes, so the best thing, if you find yourself in a position where you might need a short-term loan, reach out to us. Let's take a look at what your project is, where you're at, and what your exit strategy is, and we're able to, find you and create you a solution based off of your application.
Yeah, thanks, guys.
Thanks again to Josh and Ehren from Findlay Mortgages. Really appreciate them breaking down for us exactly how bridge financing works. I hope it brought some clarity to everyone, but if you've got more questions about financing, whether it be related to bridge financing or other types of financing, you know what to do. Jump in that comment section down below, hit us up with your questions, and we'll answer them on the next YouTube video. Otherwise, if you guys enjoyed this video, smash that like button, hit the subscribe button if you're new to my channel, and we'll see you in the next video.